Back with closing trades right here on ET now, where the closing trades are looking absolutely flat, and it's really been one of those listless Mondays that we've had at our hands. Better a day for the broader end of the market with sporadic moves in an SBI Cards, NHPC. IREDA has dashed up after quite some time, and then Idea is your top mover with a solid 7% off or notch up. Other than that, of course, there is some macro data flashing for you on your screens right now. The trade deficit data, that is, which pretty much seems in line with what the market was penciling in, because it's a $26.1 billion figure that we were anticipating for the month of August. It's largely in line with that. There was, of course, festive gold demand, which was supposed to accrue in. The US tariffs, of course, continue to remain a big overhang and a risk. And this comparable to $27.4 billion on a month-on-month basis, which is for the month of July. That seems pretty much par for the course, and it's likely to come down a little bit lower in the months to come. So that's that. We've seen a little bit of a modest narrowing, if you will, which has been largely driven by the surge in gold demand. Imports nearly doubling despite higher prices. That's the trade deficit, which is currently at $26.49 billion for the month of August. But that said, let's continue our market discussion. Just half an hour to go before we wind up for the day. Ruchit Jain as well is on the show with us, as is Kunal Bothra. But Ruchit, what are the prima facie trends that you're picking up today? Sectorally, it seems to be it's NBFCs and telecom, led by Idea, which is actually holding up. Any trades there?
Yeah, hi, very good afternoon to everyone. Well, I think if you look at the benchmark indices, then we are not in any kind of directional trend as of now. Our markets have seen some consolidation over the last few weeks, which seems more of a time-wise corrective phase. And we believe that until that 25,150 hurdle is surpassed, this time-wise could tend to continue going ahead. But the broader markets are doing well. We can see that on Friday's session, it was the defense space and the metal space which were doing good. Today, we can see some good gains coming in from the sectors such as realty is there, NBFCs is there. So I think it's more of a sectoral rotation that we can see in the market. One needs to figure out which sector is working on which particular day and participate accordingly. So we are also advising to take more of a sector-specific or a stock-specific approach in such market where the benchmark indices are not showing any kind of signs of a trended phase.
Approach for the market and the market setup going ahead. We also have Anand, Tandon, independent analyst, joining us on the show. And Anand, hi, good afternoon, and thanks for your time. Ruchit was talking about how it's time to be sector-specific, stock-specific, and time to be bottom-up. Is that your approach right now? And if so, what's looking good in the market? Because, we have seen constant sector churn. What was leading the market last week has become one of the top losers. If you could, put that analogy for a couple of sectors that we've seen. IT, we've seen that case happen with banking and financial in the previous earnings season. What is your take on what could lead the market rally going ahead, if at all a market rally is something that you're foreseeing?
The short answer is I'm not foreseeing a market rally. But that said, the market opens and shuts, and in between it trades. So it will have to do something. And when it doesn't have a direction, what it does is to change a transit between sectors. So the fact that you are seeing sector rotation clearly means that there is no leadership. And the market is somewhat confused as to where you are betting on. The stocks that you would like to bet on have perhaps run up a considerable amount and are factoring in growth rates which are going to be tough to manage. And on the other hand, those which are not doing so well have also gone up perhaps higher than they should have, but will continue to remain. And therefore, assuming that nothing major triggers a reversal in trend, the market will hang around in this area. Now, given that, we are entering into the best phase of the year where the demand will be high and a large part of the consumption growth that happens in the country will happen during the season. And therefore, there will be some news flow which will happen, which will be narratives which will be built up in terms of, various sectors doing well and so on, forgetting that, till the first half of the year, we have done actually not much. So net, I think I would expect to see this rotation continue, barring, of course, any positive developments in the international markets, removal of tariffs. Given what we know today, this is the best that you should expect.
Okay, that's the best that one should expect. But Kunal, is that what you foresee as well? You think we will continue range bound while the range may pick up a little bit and build on to 25,000, but largely pretty much intact?
I think till the time, so we look at it this way, Aisha, that till the time the sectors start to participate, large cap names start to participate, there is no going back for the index. If we start to see a reversal for many of the sectors which have been huge underperformers, then there is a case of caution for the index. So right
Which is
now,
what, IT, FMCG?
IT, FMCG, Reliance, L&T, these are the stocks which are underperformers. So, they've started to show some signs of recovery. We were discussing that the real estate stocks have managed to make a good comeback. There were two of the major underperformers, the IT and the Realty. I think IT has made a good comeback in the last week. Today, real estate stocks are showing that kind of a sign. Now, when you have that phase where the stronger sectors are still looking strong, they are still trading at a much higher price end for those individual large cap names, and then the underperforming sectors one by one make a comeback for themselves. It's just a matter of time that the indices also break past about those boring resistances and get back into that zone of momentum. So I think it's more of wait and watch. I agree that yes, when you have such kind of a vibrant sector zone, you would probably expect that the index picks up momentum pretty quickly. But sometimes I think waiting is something which plays out really well, especially in terms of these kind of setups.
Okay. Anand, just picking up on one of the points that Kunal was just making, the underperforming end of the market. And let's talk about Reliance, because even the AGM takeaways and a hint at geo listing, etc., couldn't really lift the stock up. What triggers do you think will pave the way now for a sort of holdco, if I can call Reliance that, move up?
Well, there are two things. One is that, if Mr. Trump suddenly decides that he loves India and therefore the oil sector, don't forget that Reliance is one of the biggest importers and exporters of Russian oil, and therefore is probably on the trigger of the US regulators and perhaps any other fellows who may decide to put tariffs on India. If that were to go away, there is no doubt you will see a bounce. Now, on the fundamental side, there is a different issue that you have to look at where the growth is coming from, and clearly the growth is now not coming from the OMC market. We are actually looking at the consumer side of the business. The telecom business will continue to throw up cash now. I think we have seen most of the capex behind us, and with a duopoly situation for all practical purposes and a systematic increase in the consumer prices, the cash flows there will start to get released, and that is being deployed on the retail side of the business. So the next big trigger has to be the retail. The retail right now is large, but it is not particularly effective. If they are able to manage their margins so that they bring it up to more regular FMCG and consumer durable levels, I think you can get a next big leg up. And clearly one of those can be the divestment of each of these sectors into more trackable separate companies so that the parameters of each one of them becomes more visible and easier to understand. So I would expect that Reliance will continue to remain, if it remains a holdco, will continue to have some kind of a drag on its performance. But otherwise, as soon as they split it up, you will see individual parts of the business perhaps doing better.
All right, so that's the take coming in on Reliance. Let's watch out for that. Today we have seen the stock now seem to be recovering from its day's lowest point and trading at the day's highest points rather. But Ruchit, the other pack that is seen to be a little bit under pressure is the auto pack. How do you see the sell-off in the autos that we are seeing? Because autos on the fundamental side, it seems to be now a structural story wherein the recent GST cut can get in the sales for the next 2 to 3 years at least. But technically, do you believe it is offering a good opportunity to enter in select counters?
So I think the overall trend for the auto space still remains positive. It's just that around this GST news flows, we have already seen a good run up in the Nifty Auto Index. The Nifty Auto Index gave a breakout from its hurdle of 24,200 during August, during mid of August, and just in a time frame of 2 to 3 weeks, the index rallied from 24,000 to about 27,000. So that has been a sharp up move already, based on this news flows of GST changes. So I think some profit booking is only been seen since last 3-4 day trading sessions, but this does not seem to be any kind of change in the broader trend, which is still positive. So one should keep a buy on dip approach within the auto space, and any kind of minor declines if we get further from current levels, then one should look at buying opportunities on those.
Okay, so that's the take on Nifty Auto. Buy on dips is the strategy coming there from Ruchit. But Kunal, just a few minutes ago, like Aisha was flagging off, it's actually the NBFC stocks today that are doing very well. Case in point, you have L&T Finance and Bajaj Finance, both at their fresh all-time highs today. Which one looks better placed on the charts, Kunal? Where would you be placing your bets if you had to pick between these two?
So both of them are completely different charts. Of course, from the same sector. Bajaj Finance is something which is coming back into a recovery. We're discussing this, I think on Swadesh in the morning, that there was a point where Bajaj Finance for the last 5 months, and this is in the month of March, April, May, June, when the markets were going through a good bounce, that stock was a huge underperformer. You look at the candlestick patterns over that kind of a time span, the patterns were just all over the place. The stock was not exhibiting any major kind of a trend. But look at the last 3 weeks, you've seen a very good breakout for Bajaj Finance from I think 870, 880. The stock is back again to those lifetime high levels, breaking past comfortably above the 1,000 mark. Now we compare this with L&T Finance. It's been a very stable chart. I remember that breakout point of 170, 75 for L&T Finance, I think around 3 or 6 months back in the month of March, April somewhere. And I think from those levels, we've seen a completely different kind of a chart behavior for L&T Finance. It's been stable. The stock has been consistently showing signs of an uptrend. It tends to just about participate on the way upside when these sectors, when it's, the entire NBFC sector participates. And when you see large cap names underperforming, the stock just goes into a shell and goes into a time-wise correction. So that I believe is a very good quality for in the stock price over the long term. So I think for traders with a dual time frame, so for example, someone is looking at short term, I would recommend Bajaj Finance at current levels also, expecting the stock to move towards the new levels of 1,050 to 1,100 zone. But for L&T Finance, I think this is the big breakout, and specifically on the monthly and the quarterly charts, which means potentially we could be looking at even 280 to 325 plus over the next 12 to 18 months for the stock.
Let's deals indeed, but Anand, just wanted to have your take on the FMCG pack right now, because post 22nd of September, the expectations are that FMCG too will get a big boost, including the staples. But looking at the valuations, they are not very comfortable right now. What is your own take on the FMCG basket, and anything in particular that is looking good to you? Anand, this question is for you.
Can you hear me?
Yes, now we can hear you. Please go on.
Yes, I was saying that, you just saw the report from Kantar, which says that the volume growths are between 2 and 5%. Now, if you assume that you're actually growing at 9% as they indicate, it means that we are seeing a price increase of 4%. It leads you to two questions. How are we showing an inflation of 1% if the urban prices are growing by 4%, that too for consumer goods, and that too for fast-moving consumer goods? And the second question is, assuming that actually the inflation figures haven't yet played through in terms of the prices, you should argue that you should see a total revenue growth of shrinking from here further over the next 6 months. And, it's very unlikely that you'll buy an extra toothpaste or an extra, hair oil just because they have become a little cheaper. So net volume growth not likely to move up dramatically. Prices, if at all, should be falling, and therefore the volume growth will shrink further. In that context, trying to find ways to increase margins will become even more difficult. So you should expect to see the pressure in terms of growth in bottom line continue to remain, which means you will be looking at small single-digit kind of growth numbers for profit for most of the companies, which are now trading at between 40 and 60 times forward earnings. It's a miracle that they still trade at that valuation.
Makes sense. I mean, although the only positive correlation here could be perhaps you could upgrade and move up in the value chain should, things become cheaper in the premium end of the FMCG curve. But Kunal, a non-starter, staples, you think, or is there some potential that these stocks could move up?
I think we are getting to that zone where maybe the near-term best at least could be out for many of these stocks. And I would actually expect a pause for many of the names. I think that's one of the reasons why in the last, I think, 3-4 days, you've just seen a disconnect, happening to the entire FMCG basket, whether it's the likes of HUL, Marico, Britannia, etc. You've not seen any major participation, breakout, volume churn happening to these stocks. So I think in that context, I would actually expect that the sector would probably over the next, say, 3 to 5 trading sessions or the next 1 to 2 weeks, just about gets into a little bit more sideways price action.
All right, so that's the take coming in on the FMCG basket right now. But other than that, Ruchit, anything in particular that is looking good to you within the whole cap goods space? Because what I see is that companies like Siemens, ABB, Cummins, they are making very decent moves today.
Siemens has a positive chart structures. The stock has seen some consolidation over last 2 or 3 weeks. And today we have seen that the price is giving a breakout from this consolidation, that too accompanied by good volumes. If you look at today's daily volumes and compare it with the daily average volume of last few days, then definitely on this price up move, we have seen a very good volume action. So I think now the stock has potential to rally towards 3,400 in the near term. So if anyone is looking for taking any fresh buying opportunities within the cap goods space, then Siemens looks that it could be an outperformer within the sector.
That's the take coming in on cap goods. But Anand, what is your own sense? Because with this entire fillip to consumption, which seems to be the government intention right now, it seems that perhaps capex could take a back seat. Or do you not think that's the right assumption?
I think the government is not doing this out of charity. They are doing it because they see a dramatic fall in consumption. So, there are two ways to look at it. One, you could argue that, oh, given this, consumption will go up. The other way is to say whatever you are forecasting is what will happen after the cut, because otherwise it was dropping. I tend to belong to the second camp, where I believe that if they had not done anything, you would have seen a sharp decline in consumption growth. And now perhaps that decline may not be so sharp, but even then, there is a lot of pressure in terms of cash flows with most households, other than the top few. So I'm not a great believer that you will see a major consumption uptick. Yes, it may now stay where it was, or perhaps not fall, rather than actually show a decline. Uh, Now, in that space, obviously at the highest end of the market, there is going to be growth, because that is one segment which has not been touched very much and where the income continues to grow. And therefore, luxury goods, etc., may continue. But for how long? That is not what sustains markets, or for that matter, industry.